Hey guys, it's Nick, and in this video I want to talk about the new SPAC ETF. And so basically it is an ETF of these hot special purpose acquisition companies like DraftKings and Virgin Galactic. So it's an ETF that holds a bunch of them, and I'm going to talk about what this ETF holds and the good points and the bad points about it. Now, if you don't know what a SPAC is, I have another video that goes in depth into it, but basically what it is a company that goes IPO first. It publicly lists its stock without having any business interest at all. It's just the listing. It's like a shell that's only the listing, and then they have 2 years to go find a company to do a merger with that actually has a business. And so they kind of do it the reverse way of a regular IPO that does the company and the stock listing together. So the way I like to describe it is, if you have a food truck and you have just the truck, you bought a brand new truck, you got a bunch of investors, and you said, look, I'm going to buy this truck and then I'm going to go find a food business to put them in this truck so that they can start selling food out of the truck. So the truck is the shell. The truck is the public listing on the New York Stock Exchange. So the insurance, the registration, the vendor's license and all that, that's like the SEC registration. So now you have this blank truck, and you have 2 years to find a company to put in the truck to actually start running a business, to start selling the food, so to speak. So this is the SPAC, and after they find the company and put it in here, then it becomes like a real food truck that actually has a business and is actually selling food. So this SPAC ETF will consist of 80% of companies like this, meaning they already found the company is already trading and has a business and all of that. That's going to be 80% of the value of the ETF. Companies like DraftKings and Virgin Galactic and that kind of thing. And 20% of it is going to be these empty shell IPOs that they have 2 years to go find a company to put in their truck. Okay, so this is what's going to be in the ETF. It's going to be 80% real companies already and 20% shell companies that are looking for a company. So just a few details about it. It trades with the symbol SPAK on the New York Stock Exchange, and it just started September 30th. So this thing is brand new, only has assets of $2.61 million so far, and 100,000 shares outstanding, and it's already trading at a 0.16% premium, meaning it's trading 0.16% more than the actual value of the shares that's in the ETF. And the yearly fee, the expense ratio, is 0.45. So that's $4.50 on every $1,000 per year. And the fund holding is only 36 different holdings it has, meaning regular companies and the SPAC companies that are just the shells. So what are the good things about this ETF? Well, for one, it's diversified. There's 36 companies in it, so you don't have to pick and choose which SPACs to buy because it has a broad range of a bunch of them. Also, the fees are relatively low at only 0.45% a year. That's pretty low. And there's a good mix of the blank check companies that haven't found a company yet, and the full-fledged companies that are already have an operating business. And as for the downside, and this is a big one, the downside to this ETF is that the companies that they hold in here, the blank check companies and the other companies, are not with any of the warrants. That's a big one, because when these SPACs go IPO, they give you a common share of stock as well as a warrant. And usually it's about half a warrant for each share of stock you have. So a warrant is like a call option. It gives you the right to buy the stock for, say, a certain period of time, say 5 years from now, or 5 years from the time you buy it. So if the IPO goes IPO at $10 and the warrant is for $11.50, that means you have the right to buy half a share of that stock at $11.50 for every share you bought for the next 5 years or something. So in the stock IPOs, you get what's called a unit, and a unit is just a bundle of two things, the common stock and the warrant. And after about 50-60 days, they separate, and the warrant trades by itself and the common stock trades by itself. But when you get the IPO, you get both. And usually it's, say, the IPO is $10 for the warrant, and that gives you 1 share of stock and half of a warrant for each share of stock. So let's say, for instance, you buy $10,000 worth of units at $10 at the IPO price. You get 1,000 shares of stock, and you get the right to buy 500 shares of stock at usually, like, say, something like $11.50, let's say. So that means that if the stock goes up to $20, right, you have an extra kicker of 500 shares that you can buy for $11.50, even though it's trading at $20. And so that's what, $4,250 extra money. That's the kind of the sweetener on the deal for the SPACs. And this ETF deprives you of that right. It says in the thing that it is ex-warrant, meaning there are no warrants in here, just the common stock. Here it says, tracks performance of the common stock, newly listed special purpose acquisition companies, ex-warrants. So it's really not the same thing as buying the actual SPAC when it IPOs. So this is the one big detraction here, because that warrant is like a little bit of a lottery ticket or a call option, and it's usually good for like 5 years. So if the company does good, you can make extra money on it. With this ETF, you do not get that option to do that. So that's the biggest drawback I see for buying this SPAC ETF. The other drawback of the ETF, that just a few holdings make up a large percentage of the ETF. So you see DraftKings, Derived, Vertiv, Vivint, Open Lending. So just these, first 5 or 6 up to Virgin Atlantic is 60% of the whole ETF. So that's pretty concentrated right there. And the top 15 stocks make up 80% of the whole ETF. So, and the other thing is that no single security is supposed to make up more than 12% of this ETF. So DraftKings is already above that level, and so is Derived. And so what's going to happen is, when they do a rebalancing, they're going to have to sell off some of the DraftKings to rebalance it under 12%. So what this does is it's going to limit the stocks that are doing really well. They're going to sell more and more of it as they go up, if they go up a larger percentage compared to the rest of the stocks. So it's a little bit different than, say, SPY, that the more these stocks go up, like the FANGs, they become a larger portion of the percentage of the whole S&P 500. So that's another thing to look out for on this. So basically, it's a quick and easy way to get into a bunch of these SPACs, both ones that are already found a company to acquire and ones that are still shells. It's not a bad way to do that if you don't want to pick and choose and all of that stuff and figure everything out. just allocate a small portion or whatever percentage of your portfolio you want to this and set it and forget it. But if you want to pick and choose and make a bigger return because of the potential from the warrants, you're not going to get to do that with this SPAC ETF. So that's a look at the SPAC ETF. If you want to invest in it, it's very new, just a few days old. So do your own research. And if you want to know more about how SPACs work in detail, check out this video coming up next.